Welcome to the latest of our regular market updates. Before I get started, I'd like to remind you that you can subscribe to this YouTube channel and click the bell to get a notification every time we publish a new video so that you're always up to date. Now, the last month saw a little bit more turbulence than we did over the past couple, but Moneyfarm's portfolios held strong, achieving positive returns in May. The biggest contributors to returns in this month were European assets and value equities, i.e. the asset classes that were hit hardest by the switch to a digital economy in 2020, which are recovering thanks to both the reopening and the ongoing vaccination campaign. Gold was also positive, driven in part by the decline in real rates and in part by some positive momentum that began last April. Finally, bonds benefited from the stabilisation of interest rates, while exposure to emerging countries had a month of ups and downs, and this was largely due to the appreciation of some of the local currencies. Now, as you might remember, our last two portfolio rebalances included increases in our exposure to value equities, and this has certainly paid off in the first few months of the year with this asset class outperforming. But now that the recovery is accelerating swiftly in the Western world, assumptions underlying trade could change. And this is one of the key topics on the agenda for our investment committee in monitoring this tactical choice. As we said last month, inflation continues to be the #1 concern for financial markets. The CPI in the US surged in early May. Now that's the index that measures price levels, and that shook the market. The Fed then made a point of reassuring everyone that a tightening of monetary policy isn't on the horizon, which is good news for investors. The fact, as we've seen, neither the equity nor the bond market have shown any significant sign of decline. The broad consensus seems to be a level of inflation that's under control for the medium term, and this is in line with the view that we took at the beginning of the month. Now, having said this, in order to assess the exposure to inflation risk, it's not enough just to look at the CPI level. It's also important to understand the drivers behind this indicator and whether inflation is driven by a recovery in consumption or by a decrease in supply, which could affect profits. Now, the first factor to consider is the US labour markets. Requests for subsidies are progressively decreasing and the unemployment rate has now reached relatively low levels, albeit far from historical lows. The evolution of prospects on the American labour market will also be a fundamental part because the Fed has often used this weakness in the area to justify a continuation of expansionary monetary policies. Now, another factor to consider is the trend in price of raw materials. The rally we've seen in the middle of last year has involved just about every commodity to some extent in the wake of pressures both in terms of supply and demand. In recent weeks, we've seen some adjustments in the cyclical raw materials, your copper, aluminium, wheat, and partially oil, which have contributed to the increase of some inflation indicators. So the next question is, how are Moneyfarm's portfolios positioned to handle this risk? Well, our view is that a gradual increase in inflation, coupled with a gradual tightening of monetary policy, may well be a favourable environment for equities. Even a small share of gold, correlated to the trend in real rates, fits relatively well in the context of a controlled nominal rate and rising inflation. Particularly in our lower risk portfolios, where equities are a little bit more contained, we hold a share of inflation-linked bonds, which should suffer less in this macroeconomic context. The last month saw a sharp collapse in Bitcoin, which, going from a price of $63,000 to just $35,000 in a few weeks, brought the whole world of cryptocurrencies with it. The Bloomberg Galaxy Crypto Index lost 40%. Just as we're cautious when cryptocurrencies rally, we don't now see as the time to declare the end of this phenomenon. The explanation for what happened is rather quite simple. A series of news fundamentally changed the sentiment around cryptocurrencies, and as a result, many traders decided to monetize their positions. The drop in price then triggered a panic-driven sale that also sent some of the major trading platforms into a tailspin. On the losing side, there were many investors who had bets on cryptocurrencies in recent months, perhaps riding the wave of recent positive growth. With speculative trading, these dynamics are very much part and parcel of the game. This collapse doesn't mean that Bitcoin won't grow again in the future. It's a deregulated market, it's sensitive to news and short-term sentiment, and as a result, in essence, it's always going to be very volatile. Contrary to what many are led to believe, it is a complex environment to trade, and that doesn't necessarily offer better opportunities than other asset classes. Those like us who adopt a more medium to long-term approach, we know there's a risk associated with the sustainability of individual projects. There is little doubt that blockchain is an incredibly useful technology, but we can't predict which currencies will dominate the market in the future. Now, these are some of the reasons why we consider Bitcoin outside the risk parameters for what we set for our clients. However, cryptocurrency remains something to keep an eye on, like all asset classes we monitor. Finally, I'll take the opportunity to remind you that if you want to find out more about our personalised investment proposal with no obligation, just sign up for a Moneyfarm account at www.moneyfarm.com, where you'll have the opportunity to discuss your finances with our consultants in a way that suits you. Thank you.